We're here to clear the smoke on accounting issues. This is the Issues Watch podcast. Hello, and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, so we've got just a few topics today, and some that you might think are not repetitive, but we've talked about them before, and we have, but there's kind of a recap to them. So the first one is CECL. Now, I know that you've heard me talk about CECL, you've heard me and Frank talk about CECL. It's topic 326, but what is CECL for a second? Current expected credit losses. When you hear what I talk about in the content, you'll kind of understand exactly what current expected credit losses is. But today I want to talk specifically about CECL, not the turtle, but CECL, and as it relates to not-for-profits. So there's a big conception out there, a misconception out there, that nonprofits only have ASC 958 transactions. Those are transactions they're exchange type of transactions or they're contributions. And that could be as it relates to your nonprofit organization. But you should really analyze all the type of transactions you have or items on your balance sheet to determine, could they be affected by CECL? So the AICPA, I know we're talking about the FASB right now because this falls under accounting, but the AICPA actually just put out a good article. Now, I reference articles like this a lot of times when it's, and offer them up if you want to contact me, if it's public content. So if you're interested in seeing the article, shoot me an email. I'll be happy to send it over to you. So as we said, a lot of times some nonprofits think that they only have ASC 958 transactions, when in fact, some nonprofits could have type of transactions that fall under 606. Remember 606, ASC 606, that's revenue recognition, that's how I refer to it, but it's contracts with customers, et cetera, much longer name. And what happens is a nonprofit organization has to evaluate, do they first have any receivables on their balance sheet from transactions that fall under 606, okay? If you do, CECL may apply to you, and we're gonna have more. Now, very often, most nonprofit organizations have exchange transactions or contributions. Those don't fall under CECL. You know, pledges to give, those don't fall under CECL. If that's all you have, okay, but you should document it so when your auditors come in, they see your memo and they see your evaluation of the situation, they say, okay, we understand that you only have these type of transactions and CECL does not apply to you. But again, if you have any receivables that fall under 606, and I know we have some nonprofits that have both 958 and 606, if you have any loan or debt instruments, this could be with related parties even, or outside parties. And I see that actually on a lot of nonprofit organizations that they do have loans to other organizations or debt instruments. And finally, the new one, you're gonna hate that I say this, if you have a lease receivable. So, you know, there's been a big change with 842 that came up, the ASC 842, the whole lease concept. If you have a lease receivable, this could apply to you. Now, when they came out with the CECL topic, the FASB didn't have a specific methodology that was required to be used. They said you could use a discounted cash flow rate, a loss rate, a roll rate, profitability of default methodology, or just an aging analysis. The important thing is you have to come up with a methodology and you have to apply it and you've got to analyze all of the situations to determine, are there current expected credit losses? And that's where this all ties in. This is going to be a significant undertaking. I recommend you start looking into it now because it is effective for calendar 2023. Okay, there is a proposed standard out there on profits interest. Now, why am I talking about profits, a proposed standard, you're wondering? First, there was CPEA, the Center for Plain English Accounting, actually had some guidance on profits interest. And if you're not a subscriber to CPEA, you may not have seen this. But profits interest can be really big. And before I get into it, let's see what profits interest is. Profits interests are an equity-like form of compensation through a liquidation threshold. They're valued, and meaning the LLC has to achieve certain profits at or above a certain amount for the profits interest to participate in exit proceeds. Very long definition. It differs from a capital interest. A capital interest is a type of equity commonly issued by LLCs, under which the member of the LLC contributes capital to the LLC and has an ownership interest. Profits interests don't represent an ownership interest in the LLC. Instead, they most commonly represent claims to future appreciation of value of the LLC based on profits interest liquidation threshold. Now you're sitting here saying, is this a Nicole DeRosa session? Because he's talking about profits interest and LLC. This sounds very much like taxation. Well, I'm actually talking about accounting. Because what happens if you don't analyze operating agreements for certain companies, particularly LLCs, you could find that there's situations where there are profits interests that are awarded to certain individuals. Or you're doing the tax return and you say, and you also do the financial statements, audits, review, compilation, whatever. You're doing the tax return, you know that there's this profits interest, but there's nothing to report because nothing's happened. The threshold has not been achieved. So you don't even think about it. Well, I knew somebody who had this issue, and I asked them about the LLC that they were working with, and I said, did you review the operating agreement? And they said, yeah. I said, did you say anything about profits interest? And they said, oh yeah, back in 2020 it said that they issued some profits interest. Well, where am I going with this whole thing? If you have a company that issues profits interest to somebody, it could be a form of equity-based compensation and fall under ASC 718. You remember that stock-based compensation when FASB 123 came out? It was big, and it really hit companies. You have to value these interests that are awarded to people and determine if there should be a charge on the financial statements. What's big about this proposed standard that's out there is actually giving some guidance. It comes out with, I think it's 4 examples as to what applies to ASC 718. And while you may not want to look at the proposed guidance that's coming out, I recommend it. But what you want to be cognizant of is if you have profits interests either existing or that are have been or going to be awarded, you want to make sure you're on top of this, because the last thing you want to have is a triggering event and you did not account for these properly. Okay, digital assets and cryptocurrency follow-up. So we've talked about digital assets and cryptocurrency a lot. Recent episodes, I actually talked about a proposed standard that came out. And the NJCPA magazine that's put out by the New Jersey Society, you can actually access an article that I'm going to reference online at the show notes, the link that's in the show notes. But there was a good article by Ken Heaslip, and he discusses in there the proposed changes, which we had talked about in one of the episodes. But check out his article, which include accounting for certain structures with a charge or change in what's in fair value hitting net income, whereas in the past it only was deemed an intangible asset and you had a review for impairment. Well, under the proposed guidance that's out there, and you can read it in the article, it's saying depending upon the type of structure that they have, you know, Bitcoin or whatever it is, and he talks more about that, the change in the fair value can actually go into net income. So that's a significant change that they're talking about. But the one thing that he talks about in the article a lot, which really we haven't covered a lot in many of our topics, and I'm happy that he hit on it, is the impact as it relates to the audit. And a lot of auditors get called by their clients and they say, oh, I need you to do this audit for me. It's cryptocurrency, digital assets, whatever you want to call it, blockchain. And you're like, okay, I'll try it. That's the worst thing you want to do, because you want to make sure that you have the skill set, especially not just in this area, in all areas. And the AICPA has been pushing on this a lot. And if you don't have the skill set, work with somebody who does. Okay, consult with somebody, bring them in as part of your team. One of the big areas that he mentions in there also is the audit risk considerations and relates to especially in the acceptance phase. Coincidentally, as this article came out and I was reading it, the Center for Audit Quality, which is a subscription service through the AICPA, but they came out with an audit committee tool for digital assets, and it discusses areas of regulatory, legal, compliance with laws and regulations, risk assessment considerations, safeguarding of digital assets, and third-party monitoring. And it's a really good pamphlet that they sent out, and if you're part of the Center for Audit Quality, look at that, tied in with Ken's article, and you can really get some in-depth information on digital assets and where everything is going and what you should be considering. Finally, also in the NJCPA magazine, and here's where I'm going to steal some of Nicole's time, there was actually an article by Nicholas Young on deciphering crypto assets tax issues. So I recommend you look into that, tie this all together. This is big. A lot of companies are not going into the crypto asset area yet because it is so complex and it's changing so much. But if you are going to get into the area, I recommend that you just consult with people and make sure you have a good understanding of it. So, with that, a few closing notes. Get the latest ANA news articles and events at njcpa.org/hub/accounting. Remember, this is the last year of the New Jersey Triennial. Make sure you fulfill your CPE requirements. Access all upcoming NJCPA events at njcpa.org/events and track your CPE at njcpa.org/CPE tracker. And finally, be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.